Hello and welcome to another lecture series. In this series, we're going to talk about accounts receivable, how we establish the receivables in our books, and how we value it at the end of a period, and the various transactions that could result in increasing or decreasing accounts receivable in our books throughout the year. So let's work through an exercise and see what we have here. In this case, we have Larry Corporation that has accounts receivable and allowance for doubtful account beginning balances. They've told us how much net sales have taken place, all credit during the year, how much of that we've collected. We wrote off some receivables. We collected on some receivables that were written off. And the last piece of information is uncollectible accounts are expected to be 8% of the ending balance of accounts receivable. So we will work through this by way of doing our journal entries, recording it in our journals. And we will also open the T account, only two of them, accounts receivable and allowance for doubtful account. Allowance for doubtful account is a contra asset account. Accounts receivable is an asset. It represents future utility in that it's going to convert into cash. My customers owe me money from a credit sale. Allowance for doubtful account is a contra asset to accounts receivable. The purpose of this account is to reduce the accounts receivable account, and it exists only in relationship with the accounts receivable. I'll explain that as we go along as to what that means. So our starting balance for accounts receivable is $142,000. That's always a debit balance, it's an asset. Allowance for doubtful account normally is a credit balance. Unless mentioned otherwise, we assume it's a credit balance. It may have a debit balance. If it does, you will always be told that it's a debit balance. We have sales of $945,000 that have happened during the year. So these sales have taken place throughout the year. We are doing just one journal entry. I'm just going to write XX for the date over here because those journal entries have happened as the transactions happen. To record a sale is going to be cash or accounts receivable debit. I know it's accounts receivable debit because I was told they were all credit sales. Accounts receivable debit, sales credit, and the amount is $945,000. Now, thankfully, of that money, and maybe from previous receivables, I have collected $910,000. Again, hopefully these collections have been taking place throughout the year. So again, for the date, I'm going to write XX over here. I received cash, so cash has to be debited. Why did I get cash? Because I was owed money. Now that I got the cash, I'm no longer owed that money. So accounts receivable has to be credited in order to decrease it. And that's $910,000. Now, as soon as I do these two journal entries, I'm going to go ahead and post it into my ledger, into my T accounts. So 945,000 debit and 910 credit for accounts receivable. I'm not opening the sales account or cash or any other account. I'm just interested in these two accounts. So those are the only two T accounts I'm looking at. Now, I've been told that I wrote off accounts receivable. At some point of time during the year, I got information that a client is not going to pay the money that they owe me. In most probably, the client has filed for bankruptcy, and I have given up hopes of collecting that money, so I need to take that off my books. What it means by taking off the books means I'm going to credit the account without getting cash. I'm going to credit the $5,200. I didn't get the cash. I'm crediting it. The associated account, if you recall, I said this contra asset account exists in relationship with this account. Remember, the purpose of that account was to decrease accounts receivable. Now that's exactly what I'm doing. I'm going to offset the accounts receivable with the allowance for doubtful account, take it off my books. Now see what happens over here. Accounts receivable is credited $5,200. I decreased it by $5,200. At the same time, I'm debiting allowance for doubtful accounts, so I'm decreasing this as well by $5,200. The net effect on net receivables is zero after this journal entry because both accounts have been decreased. Their normal balances, in this case it was a credit, in this case it's a debit, they both have been decreased. Now, after I wrote off those receivables, I actually collected $1,900. I guess I got lucky and I got $1,900. Now, whenever this happened, I first need to bring the receivable back into my books so that I can acknowledge that I have received it. So what that simply requires me to do is this journal entry that I had for writing off the receivable, I reverse that journal entry exactly for the amount that I've collected. I'm not worried about the others because I already wrote them off. So accounts receivable debit, allowance for doubtful account credit, I'm going to bring it back into my books. And once I do that, I now can do my journal entry for collecting the cash. What's our journal entry for collecting cash? It's similar to the second one. It's going to be cash debit, accounts receivable credit for 1900. So accounts receivable is going to get credited for 1900. So before crediting accounts receivable, I had to debit it because I had taken it off my books. They were previously written off. That's why I had to bring it back into my books, and then I take it off my books because I actually got cash. Now the last thing we have to do is we have to record our journal entry for the bad debt expense. We want our allowance for doubtful account to be 8%. Okay? We are saying that it's going to be 8% of this accounts receivable balance. The uncollectible account is expected to be 8%. So my journal entry, I first need to, before I can do the journal entry, find the balance in my accounts receivable balance. I then say, how much do I have over here? This is the balance I have before I make any adjustments. So this last journal entry is the adjusting journal entry. Once I do this, I say I want 8%, okay, 8% of my receivables. So $171,800 times 8%. That's the balance I want at the end of the year. I already have 8,060. This is the desired ending balance. So my journal entry at December 31st is going to be for this balancing figure. The balancing figure over here, I'm going to put this in a different color just to show you where I'm taking this number. My journal entry is bad debt expense debit, allowance for doubtful account credit, and this is the number I'm going to use in my journal entry. So allowance for doubtful account credit. So all along what you saw was I did the journal entry first, and then I put the number in the T account. In this case, I first calculate the number in the T account, and then I plug that into my journal entry. So I'm working backwards over here for this last part. So finally, in the balance sheet, at December 31st, accounts receivable is going to be, putting this in a different color here, accounts receivable ending balance is 171,800. Allowance for doubtful account ending balance is 13,744. So this is an example in which we have looked at how we recognize the receivables. Recognition of receivables is the journal entries where we record the fact that we have receivables. We looked at subsequent transactions that affect receivables. Hopefully the transaction we are mostly looking at is collection of receivables. And in some cases, you may write off a receivable and subsequently collect on it as well. Valuation is, what are we going to put that in the balance sheet at the end of the period? And that's the one where we are looking at our allowance for doubtful account, what the balance should be and how much should be, what the bad debt expense should be at the end of the period. So with this, we finish this topic and we'll move on to the next topic of calculating bad debt expense using different methods.